March 2026. Somewhere in Nevada, 35,000 Nvidia H100 GPUs are running at full capacity, drawing 50 megawatts of power. Training AI models that will touch every industry on Earth. Half a world away, 4 things are happening that almost nobody has connected to that data center yet. Today, we connect them. Welcome to the Global Perspective. Today, we dive deep into what ripple effects the Iran war is having on the AI industry, the only bright spot in the US economy for the past 2 years. Shock 1. The financing loop. $126 billion drying up. To understand the first shock, you need to understand something most people don't know about the AI boom. It wasn't just built in Silicon Valley. It was financed from the Gulf. Let's run the tape. Saudi Arabia's Public Investment Fund, $1.15 trillion in assets. In 2024, PIF opened talks with Andreessen Horowitz, Silicon Valley's most powerful VC firm, to create a dedicated AI fund, target $40 billion, flowing from Riyadh oil revenues directly into the veins of American AI startups. Abu Dhabi moved even bigger. MGX, a dedicated AI fund launched by Mubadala and G42, joined a partnership with BlackRock, Microsoft, and global infrastructure partners, aiming to raise as much as $100 billion for data centers and AI infrastructure. BlackRock, Microsoft, Abu Dhabi, at the same table, building the backbone of American AI. Then OpenAI, both Saudi PIF and UAE's MGX were among the key investors in OpenAI's $40 billion funding round, valuing ChatGPT's creator at $852 billion. The money powering the next generation of AI models has a Gulf return address on it. UAE's Mubadala also invested directly in Anthropic, OpenAI's main rival, making it one of the most active sovereign venture investors globally, with 8 AI deals in 4 years. Kuwait Investment Authority deployed $6 billion into AI and digital assets in 2025. Qatar Investment Authority added $4 billion. Mubadala led with $12.9 billion. The 7 largest Gulf wealth funds collectively committed $126 billion in capital globally in 2025, 43% of all sovereign capital deployed worldwide. A historical high. These governments were converting oil, a finite, politically vulnerable commodity, into equity stakes in the technology that will define the next 50 years. Petrodollars becoming petabytes. Then, February 28, 2026, Iran war begins. Gulf economies are now burning cash on defense and reconstruction. Saudi PIF had already scaled back US equity holdings by 33% in late 2025, before the war started. Analysts now warn up to $2 trillion in committed Gulf capital could slow or redirect toward domestic projects. The $40 billion Andreessen Fund, the $100 billion BlackRock GX partnership, the OpenAI round. These are the next phone calls that don't get returned. Shock 2. Helium and tungsten. The second shock is actually 2 shocks, both invisible, both hitting the chip supply chain at the same time, from 2 completely different directions. Let's start with helium. Inside a chip fabrication plant, helium is doing work you can't see, cooling silicon wafers during deposition, detecting microscopic leaks in vacuum systems, enabling EUV lithography, the process that etches circuits as small as 2 nanometers. The process that makes Nvidia's H100 GPU physically possible. There is no viable alternative to helium. In 2023, the Semiconductor Industry Association warned that if helium supply were disrupted, there would likely be shocks to the global semiconductor manufacturing industry. Qatar supplies 1/3 of the world's helium, all of it processed at one facility. On March 2nd, Iranian drones struck Qatar's Ras Laffan industrial city, one of only 2 plants on Earth that produces semiconductor-grade helium. Qatar Energy declared force majeure days later, with Reuters reporting LNG production will take at least 12 months to fully normalize. Phil Kornbluth, president of Kornbluth Helium Consulting, told CNBC it's hard to imagine less than a minimum 2 to 3 month shutdown of helium production and a 4 to 6 month period before the helium supply chain returns to normal. Helium prices have roughly doubled since the Iran war began, according to Fitch Ratings. TSMC, Samsung, and SK Hynix, who collectively make more than half the world's advanced AI chips, are now on rationing protocols. South Korea's stock market plunged 18% in just 4 trading days, the worst drop since the 2008 financial crisis, wiping out more than $500 billion in market value as the energy security disruption cascaded through Korea's semiconductor-heavy market. Now the second hit, happening simultaneously, and this one started before the war. Tungsten. Tungsten is a metal nearly as hard as a diamond. It creates the electrical connection at the core of a semiconductor chip, specifically through a compound called tungsten hexafluoride, WF6, which fills microscopic contact structures to form the electrical connections that make a chip work. At advanced nodes, there is no substitute. China controls 80% of global tungsten production. In February 2025, Beijing placed tungsten on its export control list, requiring special licenses, detailed end-user statements, and approval from the Ministry of Commerce for every shipment. The result? Tungsten hit a record high of over $3,000 per metric ton unit late last week, a surge of well over 50% for the month, and more than tripling in price since late December. According to BMO analysts, a supply deficit in tungsten is now forecast for 2026, with production geographically limited and Western efforts to build alternative supply chains still years away from meaningful capacity. There is no near-term mechanism to offset the shortfall. The Iran war didn't create the tungsten crisis. It compounded one already in motion. China started restricting tungsten exports just over a year ago, partly as US-China trade tensions escalated. The war is now squeezing a market that was already under pressure. 2 invisible elements, both in every advanced AI chip ever made, both in shortage simultaneously. One from a war, one from a trade conflict, both pointing in the same direction. DRAM and HBM chip prices nearly doubled in the first quarter of 2026 compared with the previous quarter, according to Counterpoint Research. Intel's response on its February earnings call was grimmer. There's no relief as far as I know. There's no relief until 2028. Shock 3. The petrochemical squeeze. The third shock is the most invisible and the most pervasive. Walk into any data center, past the servers. Look at the cables between racks, the plastic casings, the printed circuit board laminates inside every switch and storage array, the foam packaging around every component shipped from Taiwan. All of it is downstream of one thing: petrochemicals. The Gulf exports 20 billion to 25 billion worth of petrochemicals through the Strait of Hormuz every year. Polyethylene, polypropylene, naphtha, the feedstock for everything downstream. Since February 28th, that flow has been choked. Asia absorbs the worst of it. Asian manufacturers in Taiwan, South Korea, Japan, and China rely on Middle Eastern naphtha for more than 50% of their petrochemical feedstock. No alternative supply chain at that volume exists. The electronics industry is already passing costs downstream, fast. Kingboard laminates, the world's largest supplier of copper-clad laminates, the substrate material every printed circuit board is built on. They raised fees 10% immediately after the war started. CCL is in everything. Every server motherboard, every GPU PCB, every networking switch in every data center rack. Layer energy costs on top. Data centers consumed an estimated 200 terawatt-hours of electricity in 2025, roughly 4% of total US consumption, growing at 15 to 20% annually. The same war pushing petrochemical prices up is pushing energy costs up with it. HP, Dell, Lenovo, Acer, and Asus have already warned enterprise clients of 15 to 20% price hikes and contract resets as an industry-wide response heading into H2 2026. For the hyperscalers, Amazon, Microsoft, Google, Meta, every server rack costs more to build. Every data center costs more to power. The ROI math on their multi-hundred billion-dollar AI build-out plans just quietly got harder. So let's recap. Shock 1. $126 billion in Gulf sovereign capital that was flowing into Andreessen Horowitz funds, BlackRock partnerships, and OpenAI rounds is now competing with defense budgets and reconstruction costs. Saudi PIF pulled back 33% of US equity exposure before the war even started. Analysts model up to $2 trillion in broader slowdown. Shock 2, Part A. Qatar's Ras Laffan offline means 27 to 30% of global helium supply is dark for a minimum of 4 to 6 months. TSMC, Samsung, and SK Hynix are on rationing. Helium prices doubled since the war started. South Korea's stock market lost $500 billion in 4 days. Shock 2, Part B. Tungsten, the metal inside the electrical connections of every advanced chip, is up 557% since China imposed export controls in February 2025. A supply deficit is now forecast for all of 2026. Western alternative supply chains are 3 to 5 years away from meaningful capacity. There is no short-term fix. Shock 3. $20 billion to $25 billion in annual Gulf petrochemical exports through the strait are disrupted. Polyethylene up 38%, polypropylene up 41%. The world's largest CCL supplier raised prices 10% on day one. Consumer electronics manufacturers are warning 15 to 20% price hikes through H2 2026. None of these are individually fatal to the AI boom. The demand is real. The investment thesis hasn't changed. But here is what has changed. The Iran conflict has revealed a strategic choke point hiding in plain sight. The world's most important memory chip producers depend on energy supplies that move through some of the most geopolitically volatile waterways on Earth. And it's not just energy, it's helium from Qatar, tungsten from China, petrochemicals from the Gulf, capital from sovereign wealth funds in Riyadh and Abu Dhabi. The AI supply chain runs through a handful of geographic choke points that almost nobody in Silicon Valley had mapped until now. IDC models a full percentage point drop in global IT spending growth if this conflict extends past 90 days. 1 point sounds small. At the scale of a $5 trillion global technology industry, it's $50 billion in deferred investment. Semiconductor supply risk is shifting from cyclical demand swings to structural geopolitical exposure. The AI boom is not dead, but the assumption that it could scale infinitely, cheaply, and without geopolitical friction, that assumption just got stress-tested by a war, by a trade conflict, by two invisible elements that almost nobody was watching. And it didn't pass cleanly. The next time someone tells you the AI boom is unstoppable, they're probably right about the destination. They might be wrong about the timeline, and they're almost certainly wrong about the price. If you liked this video, please drop a like and subscribe. Stay curious and informed. See you next time at The Global Perspective.